An Introduction to Business, Financials, and Model Logic. The new analysis wizard will guide you through setting up a new analysis. In this example, we create an analysis that uses a simplified forecast input. In this example, we want the period type to be monthly. I assume revenues of 100 in all periods. The analysis is then created. The model. In the top left area, you can select Output. And you can change the output layout. You can see that the input revenues is equal to the output revenues. The input is done in user-friendly spreadsheet format. You can input formulas, and you can drag and drop formulas and cells as you would in a normal spreadsheet. Click the Calculate button to save the updated input, and to make a new calculation. The calculation is done, and the output is updated to show the new data. The output variables are structured into topics. I select to include cash to the output. The chart shows that the cash increases each period with the period's revenues. I will include a help calculation in the free space area to verify and explain how the periodic cash is calculated. The free space area is really helpful. The area can be used for more detailed input, help calculations, etc. As you can see, the manually calculated cash in the last period is equal to the model's calculated cash. I will now include costs in this example. As with the revenues, I assume that the costs are equal in each period. I click Calculate to update the calculation. The calculation is now updated with the newly input costs. I include the costs in the chart. The costs in the chart are equal to my input costs. I select an output type that includes a line that shows the difference between the two selected variables. That is, in this example, the extra included line shows the difference between the revenues and the costs. The difference between the revenues and the costs, in this example, is equal to the net profit. I change the selected output to show the net profit. And in this simplified example, the net profit is equal to the net cash flow. The net cash flow in each period is added to the cash. That is, the cash, the green columns, increases each period with the period's net cash flow. I will now create an example where we have negative cash flow in the first periods. I increase the revenues with 10 in each period, and I set costs to be 130 in all periods. I click Calculate to update the calculation. We see that the costs are now higher than the revenues in the first periods. I select an output type that includes a line that shows the difference. The costs are higher than the revenues in the three first periods. We will now go more in depth on how the cash flow is calculated. I first select to show the operating cash flow. The operating cash flow is the difference between the revenues and the costs. I then select to include the financing cash flow in the same chart. The operating cash flow in the first 6 periods have a corresponding opposite financing cash flow. The financing cash flow is the cash flow that comes from increasing debt and repaying debt. Debt is automatically increased if there is no cash and the cash flow is negative. This debt increase is also assumed to be repaid as soon as possible. Instead of showing debt, the green columns, I select to show the operating cash flow. Again, we see that the financing cash flow and the operating cash flow in the first 7 months cancel each other out. August, the 8th month, is the first period with positive net cash flow. Instead of showing the financing cash flow, I select to show the cash. The chart shows that the operating cash flow and the cash in August is 40. In this example, we can also input equity financing directly. This is a positive cash flow for the company. We will now get to see if the input equity financing in period 1 was enough to keep the cash from going to zero. The green cash columns are positive in all periods. I will now include a help calculation to learn and check how the net cash flow is calculated. The net cash flow in period 1 is equal to revenues plus financing minus costs. The manually calculated net cash flow is equal to the model calculated net cash flow. In order to test that the next period's net cash flow also is correct, I drag and drop the formula to the next cells. The second period's cash flow is also correct. Instead of input financing here, I will assume that this company had cash at the start of the first period. To input this start position, I select the Balance Sheet Input tab. I input the assumed start position, and then I save the input. I select to go back to the Forecast Input tab again, as this is where we have most of the input. I then click the Calculate button in order to update the calculation with the new data that we have input. The net cash flow in the first period is now equal to the operating cash flow.